From thetraderguy.com, this is Chris, and I'm looking here on May 23rd at the British pound, Swiss franc daily chart. I think there's a lot going on here that should be paid attention to. When I look at this chart, there is a proclivity. The first thing that I would say is there's a proclivity, which those of you who have followed me in the past wouldn't be surprised that every 500 pips causes some type of reaction. And we've recently sliced through the 1.35 level, which of course is very bearish. And quite often what you'll see is a return to a range, and then we go to the next range. Quite often beyond that, what you'll see is somewhere in the middle of the range, you'll see some type of reaction. You can see here we broke higher, have pulled back to find support, and have continued. You can see the middle of this range has caused reactions. And here during the day on Wednesday, we certainly have seen a reaction. This is roughly the middle of the next potential 500 pip range. So these are things to pay attention to. Beyond that, I have the 200-day simple moving average on the chart, and you can see that price is currently testing it right now. It has respected it once before as we began this uptrend, which a lot of traders will use this moving average to define, which direction the market's going overall. So that's bullish as well. And then finally, what I'm going to do is I'm going to draw a Fibonacci retracement. And you can see that the 61.8% Fibonacci retracement level comes right in with the 200-day moving average, which for lack of a better term right now, I'm going to call 132.5. So when you look at this, there's a lot of things lining up for this to be a potential bounce. Now, how do you play this potential hammer? And I call it potential because as I record this, we've got somewhere around 6 or so more hours left in the day before GMT flips over. The traditional way is to buy on a break above the top of the candle and put a stop loss underneath the bottom of it, and that's fine. Now, I would point out that there's a lot of noise above, so if you take a trade like this, you must be willing to handle the massive amounts of volatility that are involved. And one of the best ways to do that is play a small position. Take the leverage out of the marketplace. But you can see that clearly we have seen, when you zoom out, we have seen a significant move. So even though this pullback looks kind of horrific on the zoomed up chart, really when you look at the entirety of the situation, it's not much. You can also make the argument that we're trying to form some type of uptrend line and trying to continue it. You could even go further and try to draw an uptrending channel. That's a bit much, but as you go through, you can see the symmetry of this. So I find this a very interesting chart. I am pretty negative of the British pound in general right now, although I think it will outperform the euro longer term. But this is the Swiss franc, and the Swiss franc is highly sensitive to what's happening in the euro. There's Italian bond issues. So much of Switzerland's exports, off the top of my head, I want to say it's about 88% goes into the EU, so there is some correlation there against other currencies, such as the pound or the dollar. So looking at this, I think what we're going to see is a potential run higher, but you have to be able to have a large stop loss. I would suspect that 135 would be the initial target. If we can break above, say, 136, we'll go to the highs. Otherwise, and there is an alternate scenario here. There always is in every trade. If we break down below the bottom of this hammer, that is a very negative sign. We almost certainly will test 130 and probably go down to 128.5, which is the beginning of this move. My experience has been, and I don't have stats for this, this is anecdotal, but typically if you break down below the 61.8% for any real length of time, you're going to wipe out the move. So this is a very interesting trade. I think either side of this candle is definitely feasible. It makes sense as a trade. And you just put your stop loss on the other side. But again, you're going to need to be able to ride a lot of volatility. You're going to need to be able to let this market do its thing. And one of the easiest ways is to cut your position size down.